Well, good afternoon, everybody. Welcome to our March 29th. It's our final day of the first quarter, at least with respect to bull sessions. My name is Mark Robertson. I'm joined here by Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. It's a beautiful day up here. I don't know if you have the bright sun. I wish it was warmer than 28 degrees, however.
We do have sunny skies and pretty good looking weather out there, but it's kind of a trap. It's pretty chilly.
You haven't hit 40 yet?
No, but we are supposed to get 50 with precipitation tomorrow, so we're looking forward to that.
Yeah.
All right. So tonight is a roundtable. So we do try to keep these bull sessions that happen to coincide with a roundtable day fairly brief. We are going to cover the fact that we have a new sheriff. He's actually one of our own. We'll talk about that. We're going to talk about the Chinese lockout and the impact that's going to have on the best small company portfolio as we dismiss one of the companies, GreenTree Hospitality, and switch it out with something else just because the stuff in China looks like it's going to go on for a while, and we just have to make it from now until Halloween. So we thought we would try a few things. Again, new sheriff in town. We'll talk a little bit about the spirit of St. Louis and some expectations investing stuff. But most of the program is going to be on taking a look at a replacement candidate and a few other things. So let's go ahead and get underway. You guys all know the drill. I see a lot of familiar faces. Welcome back. No investment recommendation is intended. This is all about education and demonstration, illustrating the methods, philosophies, techniques, core beliefs of the modern investment club movement as interpreted by Manifest Investing, championing the same type of methodology and thinking as the National Association of Investors, also known as Better Investing. So you're going to hear opinions, things that we have explored and are just simply sharing potentially actionable ideas. Please do your own homework before you make any buy or sell decision of your own. We might hold things in our own personal portfolio, so we'll definitely let you know about that. And tonight is the roundtable. Starts at 8:30 this evening. And again, that's just sharing 4 or 5 ideas and going through the analysis and a little deeper dive on some of these companies. Our 2 email addresses are at the bottom if anything else is on your mind or if you'd like copies of the slides. Anything else, Ken, before we get rolling?
No, you're on a roll, Mark. Keep moving. Yep.
All right, just a quick reminder. Yes, the green bars will approach the blue line at some point in time. I do not know when. We had seen a bit of a spike up with that downward trend in the market as far as the value line median appreciation projection. That has kind of gone back to where it was. Kind of subsided back a little bit back with a little bit of an upward spike in the market over the last few days. So that's just our long-term reminder that those green price bars represent the companies in the value line standard edition and index, if you will. That's what this $VLE, that's the ticker for it, using stock charts if you want to play around with that as part of your homework. Okay, here's our busy slide that actually comes around every quarter, and it's simply the answer to the question, do stock selection guides work? And the premise for this is the work that is done at Value Line with the company report pages is done in a very stock selection guide-esque manner. They use price to cash flow instead of price to earnings, but they basically have a very similar methodology to Manifest Investing and Better Investing. And what you're looking at here is just a display of forecast versus actual. So let me show you how you would actually read this. Back in March 2018, the value line median appreciation projection was 8.8. That's this point right here that's being pointed to. And then basically the point that is right up above it, this one right here, is what actually happened. So the green dots and the green line are what actually happened. The maroon or red bars are the predictions of what would happen. So again, 4 years ago, they were calling for a median appreciation projection of about 8 or 9% per year, and that actually came in at about 12%. And so as you look back over this over time, you can see, I think without standing on your head too much. It actually has been fairly reliable, except in dramatic moments in the market, like we had back in 2008, 2009, and that sort of thing. So that's basically what this chart says to me. Does it say anything like that to you, Ken?
Um,
I know you like this number down
Mark,
here.
yeah, I like everything on the chart. I'm wondering if it's telling us something about COVID also. Um, that that's one of the few times since the chart begins that we have 1, 2, 3, 4, 5, 6 quarters, considerably above the purple bars or whatever color that happens to be
This
there.
little gap here is what you're talking
Yeah,
about?
that little gap. But I wonder if that gap has anything to do with COVID. I noticed the last time we had a gap for a sustained period of time, it was back in 2012-13. It only looks like it maybe went on for 4 quarters, maybe 5 quarters. Uh, Maybe a small one back in 2005-6 also. But I think it would be interesting to ask ourselves the question, what's going on when these quarters persistently stay above the value line medium appreciation potential? Is that a value line problem that we can factor into our analysis, or is this just strange data, and the data works out much differently than the mathematical model says it should have?
Yeah, I'd never quite thought of it that way, but you could actually make that out to be I'm going to call it a chasm of pessimism for that period in time. That's, that basically means that these red bars maybe were a little bit more subdued than they needed to be.
Well, I think that's where I was going. That
Chasm of
that value
pessimism.
line maybe was a little bit behind the curve as far as where the economy was really headed. This wall of worry they constantly talk about maybe got to some of the analyst community at that point. Anyway, I'm interested to see if those dots continue to stay above for the next couple of. We have at least 2 more quarters before we hit that dot that's considerably above the rest of them, that bar that's above the rest of them. So it's an interesting thought problem, I think, to place in front of yourself when you have nothing else to do except count your toes. So
All
yeah.
right. Speaking of counting toes, let's go ahead and talk Groundhog for a minute. Here's our quick Groundhog snapshot for today. We do have a new sheriff in town. Sean has taken over the lead in the Groundhog in the number 1 position, so we had to break out the lederhosen. You can see that many of the leaders are still hanging around at the top. A bunch of investment clubs seem to be coming up, bubbling up to the top. And Ken is just barely off the list, and I've actually climbed within striking distance of the list. So anything jump off the page at you, sir?
Well, I like the fact that my name and your name are moving up the list rather than down the list for a change. And I like the fact that the monkey is moving down the list. My thesis is that monkey should end up, if this truly was a random set of choices, that monkey should end up in the bottom half of what we end up doing here when the whole thing is finished.
Well, if we get to be approaching next Groundhog Day and the monkey's up at the top of the list, we'll put out sell recommendations on all of the monkey's selections.
All right,
See if we can't
that makes
bury
sense.
him with the January effect or something. But
Yeah.
good stuff. So,
It
Sean,
it
congratulations,
is
Sean.
it is interesting, Mark. All the clubs that have moved up above the value line arithmetic index there, and especially some of these clubs that we've seen up there near the top before. The Long-Term Investment Club from Wichita, the Northern Traders from Traverse City. Those 2 clubs have a pretty decent track record in the last 3 years. So I like to see the clubs moving up the list. One of my clubs is actually moved up and is only 2 or 3 spots beneath my position right now, and I would love to see that club pass me and move up into the top 20 if they could. So it's it's really good to see these groups. And I don't know if the group is really a product of groupthink or not, but whatever the method of choosing stocks, these groups seem to be able to do it on a fairly regular basis.
Yeah, some of them are more than others. I know that this Montgomery Club actually had a selection show, much like our Best Small Company show, Ken. They actually had
Uh,
a chapter sponsored selection show to build their list. So that's good, clean fun. All right. Well, here's how Sean's doing it, and we just had to have some fun with this. Yeah, his number one position is GameStop, which you have, if you haven't noticed, is up huge. We'll see that on the next slide, but it's got a pretty good eclectic collection here of companies. I think Switch will actually look better on the next analyst update here fairly soon, but there's some pretty tried and true companies in there, along with the run on GameStop, which we're going to talk about for a minute. Any of those on your list, Ken?
well, I really like Western Alliance. I've liked Western Alliance Bank for a long, long time. I don't have any. I think I have Western Alliance in my portfolio, but I don't have anything else. And my premise that I'm working under from personal investing right now is that the last 3 or 4 weeks have taken the financials down and beat them up pretty good with all this talk about not knowing what the Fed is going to do and all the uncertainty around the inflation front compared to the rising interest rate front. I think the more this analyst community talks about all these problems, the more confused they get as to what they actually think is going to happen.
Yeah, I have very similar thoughts when we get to the best small companies. It's going to come out again, but again, just this notion that do you suppose maybe these banks have done this before? You know, this is not exactly new to them. All right, here's a look at how hot GameStop has been, and it's maybe in another one of these short squeezes. Um, Perhaps a subject we could talk about in greater detail, but it has gone from 80 to 190 in a few days. This one, you know, as Sean will attest, as a shareholder, some of his weeks are pretty good years, or pretty good decades for that matter.
Yeah.
So this is a wild one for the ride. And those of you that were with us about a year ago when we talked about those days when it shot from 20 or 30 up to nearly 400, I believe, at one point. I actually owned it from 40 to 80, and then watched it go from 80 to like 200 in this on the same day. So it was just an amazing ride. And if you want a little bit of a recap of that, if you don't mind a little bit of strong language, there actually is a show that's brand new on HBO Max, Gaming Wall Street, where the GameStop issue, including the naked shorting and all the stuff that went on with Citadel and the hedge funds and the crazy retail investors known as Redditors, or they refer to themselves as apes. This all contained in that documentary. My wife and I watched it just a couple nights ago, and again, a little bit of strong language, but kind of interesting to see some of the stuff that they've definitely been kicking up. And then
I
one
had an
last,
opportunity, Mark, to listen to. I really am watching for a good, solid interview of the new GameStop CEO, but I listened to the CEO from AMC, which had been in a similar kind of position with just wild swings in its stock price. AMC is the movie theater, ostensibly, company. Even though they just bought a mining company and just did all kinds of I won't say out of character things, but they certainly were things that kind of draw you up and make you look at it and say, what's going on there? And this guy is either one of the smartest people I've ever had an opportunity to listen to, or this guy is just smoking some really good stuff. I don't know what he's doing. One of the two,
And
because
that could work out.
well, he's on a ride right now that he thinks is going to end up making anybody that rides along with him multi-millionaires. So we'll see if that where that ride ends up in another 2 or 3 or 4 years. But
Right.
very, very interesting interviewer.
Well, I do think that the new head guy at GameStop, again, his name is Ryan Cohen, and he came to GameStop following a fairly successful run at Chewy, a company in the pet services business that is giving Amazon a real run, at least in that segment of their business. So he actually has a pretty good track record. And the story here, just to kind of summarize it in shorthand, this is a company, traditional brick and mortar with some really antiquated practices and stuff, and I'm sugarcoating, that basically was in a whole lot of trouble. Declining sales, deteriorating margins, all that kind of stuff. Fast forward to a couple years from that, basically he began getting involved, sold off a bunch of shares, so they shut down some less profitable businesses, began exploring streaming, began exploring things like the new esports stuff, and basically attempting to bring some of the stuff that worked on the Chewy strategy for competing with Amazon and taking advantage of that, and basically restaffed with a bunch of people from the Amazon technology realm and a few others in that area. So he's basically paid off virtually all of the debt. They're down to very little long-term debt. And the financial strength has actually gone from C something to B++. And Value Line doesn't do that very often. So you basically have a real turnaround story. This is not a short-term thing, in my opinion, although the price is bouncing around like crazy. This, in my opinion, is feasible. And it is feasible that at some point in the not-too-distant future, they are going to return to some decent level of operating margins for a retailer. It's sheer speculation, but it's not without foundation. And he has repaired the capital structure of the company to the point where even at this elevated price, I think it's elevated, near $200, you still do have a projected return on value because of what he's done to the capital structure. That's actually pretty decent for a company that's had a 200% run in the last month. You see that here with the relative strength index. Is there a disagreement? Absolutely. I can't believe the number of analysts that have walked away of coverage on this company, and there's the only analysts that are still sticking around have a extremely low target on the company, target price for the next year. Interestingly enough, Morningstar is not one of them. Morningstar actually has a different opinion than some of the traditional analysts covering the company. So again, quite a turnaround, quite a speculation. Not for everybody, but I sure wish I was in the group that bought it between $4 and $8 a share. You know, back in the middle of all of this right here. So anyhow,
Would you still be holding it, Mark?
well,
If
Ken,
let's say you had bought it at $4 or $5 a share, would there have been a point where you would have decided that it was time to leave?
I'd like to say that I have what they refer to as diamond hands, but I'm not kidding. I bought it and sold it. I went from 40 to 80 in a few minutes, and I sold it. Now I do have one share that I'm holding just in case it goes to $100,000 a share or something like that. But no, I have a couple shares, but that I'm basically I put them in a desk drawer because you look at that picture and who knows. But no, I wish I could say that yeah, I would have held them. By the way, the guy that testified before Congress, he holds I'm not sure how many, but millions of dollars worth of shares. He did hold it. I mean, he went from $4 to 400 something and back down to 40. Didn't budge. Didn't sell any that anybody knows about. And these guys on Reddit all publicize their portfolios. Now he's actually had to kind of constrain that a little bit. But wow. All right, enough on GameStop for now. Again, if you want the whole sordid story of it, and it seems to be continuing with the short squeeze and the stuff going on, take a closer look. All right, just a couple slides here for some fun. I thought you'd get a kick out of this one, Ken. I know it's one of your favorite subjects. I got a big kick out of this. Ronnie Colvin on Twitter posting this, and it reminds me. I still remember the image of my neighbor in Wheaton, Illinois, walking through the snow barefoot in his pajamas. And he had his mutual fund statement. He'd bought shares of a mutual fund just a few months before that, and he was getting hammered by the capital gains distribution. And I had to explain that to him, and I don't think he was happy with the explanation. And it pretty much went like what you see here on your screen. Your thoughts, Ken?
Well, I think we, the financial community, the analysts, the people that are supposed to be helping people, I think back and I can remember a world where mutual funds were a very rare occurrence. And when mutual funds began to be something that were something that the average Joe began to know about, I think we did a terrible disservice to those people by not explaining that there were real tax consequences that came around every end of November, beginning of December, and that could throw your estimated taxes for a loop, could throw what you normally do for taxes for a loop if you held a lot in your mutual funds. And we didn't tell people about that. It was the dirty kind of underside of mutual funds, and if you held them, you knew about them, but you didn't worry about them too much until the amounts in those mutual funds started to become significant. And that meant that the capital gains on a lot of years became significant. What was especially galling, Mark, was on some really bad years in the market, 2008 to be exact. Some of the capital gains distributions in 2008 were just fantastically high. So here you are with your mutual fund worth 2/3 or a half of what it had been worth a year earlier. And on top of that, you have the insult of having to pay a significant amount of capital gains tax because the manager of the mutual fund chose to do a lot of selling. Maybe he panicked, maybe she didn't quite understand what she was doing to the average Joe that held her fund. But when those kind of things were going on, it wasn't fair. ETFs, to my mind, are much fairer way to go. At least you can understand that, well, until maybe President Biden gets a hold of it. I'm not quite sure what his new tax proposals are saying, but right now, at least with an ETF, you can be fairly certain that it's going to spin off taxes perhaps when you sell it, but not before.
Yeah.
So this was inexcusable, all of this kind of stuff going on, and it's still going on. So
Yeah, the ETFs are more tax efficient for sure, and this to me is such. I have a few mutual funds, but all of them are in qualified retirement accounts where I don't have to worry about this picture. So, oh well, just thought that was some fun. Threw this one in there just for a little context, Ken, because you talk about those mortgage rates on the left-hand side of that screen, and there's probably a lot of people here that don't remember those. So I just wanted this for a little context as to where we're at, and if we tack on a 0.25% or 0.5 or 0.75, still in a pretty good favorable spot from a long-term perspective.
yeah, I want to make the same point on this graph that I make when I do SSGs, Mark. SSGs call out average high values and average low values for PE. But when you're calling out an average, you must remember that there are always numbers above that average and below that average to form that average. So when you call out an average up there of about 18%, be aware that in that time frame, there were mortgages that were well over 20% as well to form the top half of that average of 18 plus right there. I personally had a mortgage on a house for maybe a dozen or 14 years at 18.25%. So it was there. It was something that you lived with, and you paid your principal down very, very slowly.
Yep. I remember relocating to Southern California in the mid 1980s, and for the first time, I saw houses that were sparsely furnished, and that was because you were paying some fairly substantial interest rates. So yeah. All right, and one last one on perspective. Believe it or not, the cover of The Economist on the left is back right in the early days of COVID, and side by side, it's a pretty stark thing. It's one of the reasons that Len Douglas is so near and dear to our hearts, because Len has been talking about opportunities and value in that sector, pointing out things like the amount that is not related to gasoline and all of the petrochem and plastics type stuff that goes along. There's more to that picture, and it's a longer term picture, and I just think it's pretty powerful, those two covers side by side.
Mark, what's the time frame between those two covers? Do you know?
Well, that's
Uh,
the one on the right is from a couple weeks ago. I can't read the dates on them. And the other one is from March 2020, the one on the left.
okay, so we're talking essentially 2 years, right?
Yep.
From cover to cover. All right.
All right. So just perspective. Again, things can change pretty dramatically. And just this overarching feeling that things are never quite as fatal or terrible as they seem to be most of the time. All right, let's do some work, Ken. You and I have some work to do. We continue to trail the overall market, but continue to lead the Russell 2000 Growth ETF. So we're happy about that. Half happy, I guess. We are going to go ahead and shed GreenTree Hospitality from the portfolio, even though it's probably well positioned long term, theoretically. But like we said, with the shutdown stuff going on in China and all that stuff continuing, I replaced the waving cat with the dragon. I couldn't find a waving dragon, Ken, so stick with that. And you can see that the portfolio is holding up fairly well, but we'd sure like to see it do a little bit better. We do think it's fairly well positioned top to bottom for the stretch drive run until Halloween next year. Okay. Here's basically the rationale. The lockdown is never let up, and it's even intensifying, as recent news lays out. And no end in sight for that type of stuff, at least for now. Of course, if we sell this, Ken, you know that things are going to probably change dramatically. So the rest of the world can thank us if that actually materializes.
25 million people in a single city. Okay.
Mm-hmm. All right. So one of the things that we started last week, and we did a little bit of this on the forum, is again trying to go searching for a relatively small company to replace GreenTree Hospitality, and basically came up with this list of potential candidates. Went through a number of these on the forum as we hunt out our next rabbit. You want to share your thoughts on First Foundation or Houlihan, Ken, at this point, or what are you thinking from 35,000 feet?
Well, I told you before we started that I'm not especially enamored of any of the companies on this list. Of the group, I tend to gravitate towards Capital Bancorp and First Foundation. I think right now that we're at a moment when financials are undervalued for the reasons I stated earlier, that there is so much uncertainty about forces that nobody knows how they're going to pull the economy. I think good bankers have experienced these kind of forces a number of times and are going to be able to move their banks through this particular kind of uncertainty and make things work. First Foundation is not really a bank. It's an asset manager, and it's a private bank, if you will, deals an awful lot in trusts, deals an awful lot in setting up advisory services for wealthy clients, and then offers a whole scope of different kinds of services and different types of investments that you wouldn't find in a normal brokerage house or at a normal bank. It's focused at the high net worth individual, has extremely consistent growth in its sales, almost as consistent growth in its earnings, and it's out in Southern California, and it just seems to do pretty well on a pretty regular basis. There's that consistency in sales, that top box right there, and it's you can see the consistency in earnings, not quite as pretty, but still a pretty nice set of data points. Return on equity moving in the right direction, obviously. PE ratios, well, the whole banking industry, PE ratios of 10 to 15 are pretty common right now. I think that's bargain territory, and so that's why I'm suggesting First Foundation as my first choice, with the backup being the regional bank that I mentioned, Capital Bancorp, a really solid regional bank. We already have some regional banks in that small company's portfolio, however, so my first choice would be First Financial, but I'm willing to listen to your presentation on YETI as well, Mark.
Yeah, and I was drawn to YETI, and we'll circle back to that. I mean, we're basically shedding a discretionary consumer discretionary company in GreenTree Hospitality and replacing with YETI. If you're not familiar with YETI, they make the coolers and the beverage, hot and cold beverage containers that are fairly ubiquitous, and that Ken has that concern. How much more can they do? And I admit my family seems like they lose them every once in a while, and they have some turnover there in the replacement end. But YETI from left to right has some pretty good numbers, and a very good product. Trex, kind of a similar mentality. So a lot of people using Trex products on renovation projects in their homes. And down at the bottom, this 51 job just kind of caught my attention. Couldn't bring it all the way home, but I do want to study it more closely. But one of the things that I noticed in this week's update of the value line update, it includes the staffing and employment services. A number of these companies showed up in the materially stronger category. And, Heidrick and Korn Ferry and ASGN and Robert Half, these have all been roundtable companies over time. Some of them have performed very well for us. So I just threw that up, showing that some of these companies appear to be, strengthening, and, with what we're facing probably on a global scale, with the return to more traditional work systems in the future. So that's just there for fun. And then Ken had actually mentioned last week that Sportsman's Warehouse was one of the companies that jumped off the page here, and I threw this slide in there. This is straight out of our forum. What happened in December? And Ken, I think this is a great example of what happens when a relationship sours.
Yeah, we get this question all the time, Mark. Somebody has made a bid for another company. They're going to either buy the company, or they're going to merge with the company, or they're going to do a spin-off of a company. And the prices for the deal, whatever the deal happens to be, are announced. And one of the companies, sometimes both of them, but usually one of them, the one that's being acquired in most cases, jumps up to close to the price of acquisition. So the question comes in from our community, do I sell now? Do I wait till the deal closes? What do I do? And our answer has been pretty consistent over the years that, in our opinion, the chances that you're going to do much better after the acquiring price is announced and the price jumps up, the chances that you're going to do very much better are very slim. And we suggest you take the money and put it somewhere where it's going to have the opportunity to grow for the next 6, 9, 12 months, however long it takes to seal the deal. We do say that one of the risks that you take if you decide to hold on till the end of the deal is if one of the two decides they don't want to participate in the deal. If the acquirer walks away, if the one that's being acquired suddenly decides they don't like the terms of the deal, then what happens is the stock that went up to the announced price that they were going to buy the company for suddenly moves back right down again, and you can see it in a beautiful stair step there. It moves down to where it was trading previously. Nothing to do with the quality of the company, just the fact that there's suddenly nobody interested in buying it at a premium. So it revalues itself at a much lower price, probably pretty close to where it was before the deal was announced. This is classic. We should probably keep this slide so the next time we have that question coming up to us at one of the roundtables or one of the bull sessions, we can pull the slide out and say, here's the risk you take, and we suggest you buy at the top level rather than the bottom level.
Absolutely. All right, so there's First Foundation. Here's a picture of YETI, just showing the tremendous consistency and, I mean, operational excellence when it comes to this company. It is continuing to grow at a 15 or 16% growth rate. I mean, not the smallest of companies, and that gave me a little bit of heartburn. This is probably our last shot at this one, Ken, for the best small company list, because if they execute properly, they're going to become too large for the small company stuff. But again, they're doing a good job of penetrating with a number of retailers. They do a lot of wholesaling. They do some third-party branding type stuff. But you're looking at a company, again, growing at 15%, generating a fairly consistent operating margin. I would expect that to plateau somewhere in the 20 to 25 range when that happens. You do still end up with a really decent up, straight, and parallel trajectory. So really, for me, this is a pretty good situation. They have more cash than long-term debt. What long-term debt they do have is at a very attractive interest rate. There's just a lot of really nice indicators here. They're within 5% of their 52-week low. Value Line likes it by virtue of that. So does Morningstar. Again, it's not an exorbitant PE for a smaller, faster growing company. And I think there's a lot to like here. I might even bring this one back tonight, Ken. There's a lot to like here in this story. And again, the biggest question is, what's the size of that field? What type of things might they develop in order to keep expanding and continuing to grow? What are the threats to that growth is what I would key in.
We don't use polls very often in the bull session, but we're going to put a poll up there right now and ask you to kind of give us some advice. We're not going to guarantee that we take the advice, but we're going to see where you're coming from as far as those two companies are concerned. Here comes a poll right at you right now. If I can get it to work, there we go. And we're launching the poll. If you had your druthers, which would you put in the best small companies? First Foundation or YETI?
It's always interesting to see, where the people lean in our community. And before the session, I basically predicted, well, first of all, you never vote for me in the first place, but I basically predicted that we would be taking a small slice of the discretionary here, which is the biggest piece, and switching that over to financials.
Yeah, remember, we're not putting a full position into the best small companies. We're only putting as much money as currently exists in green. It's Green Brick, right? No,
GreenTree.
GreenTree, Right. So I'm going to close the poll down, and I'm going to share the results. And it's by about 2-1 that they'd like to place First Foundation onto that list of best small companies. Again, no guarantee that that's what we're going to do, but we do appreciate the advice from a group of people that we really truly do respect. So let me hide this poll. And Mark, why don't you kind of continue where we're going then?
Okay, are we back showing the pie?
Yes, we are.
Okay. All right. Well, I'll tell you, Ken, I'm leaning towards taking the audience's recommendation because it does take a little bit off of the consumer discretionary pie here and move a small part of that over here. And as we were suggesting, it's probably not the worst time for banks and financial institutions who know how to execute and take advantage of what's going on in their marketplace. So we shall see. And hopefully it will outperform the GreenTree Hospitality between now and Halloween, because that's the whole goal, really. All right. One last thought. I thought we'd spend just a moment. We're a couple months before the anniversary of what we refer to as the Janke Utility Reserve. And some of you probably remember we set this up last May. And what it's intended to be is basically a portfolio which pays the electric bill. And we invested about $9,000 into each of 5 utilities. And this is just giving you an update as to how those 5 utilities have done. That relative return is versus the average utility, by the way. It's not versus the market, versus the average utility, because, again, we're building kind of a conservative dividend yielding portfolio. And as is shown here, this is basically how we look at a cash flow internal rate of return at manifest for any type of portfolio that we do. And you can see that those $110 checks have religiously gone out between last May and now. And you can see the dividend payments along the way. And I'm just kind of pleased to report this is working out pretty well. The utility's been paid that original $330 amount in the money market fund or checkbook after paying all those utilities after dividends is up to $558. And again, the story behind it, this is how Ken Janke got his dad to accept investing in stocks back several decades ago. His dad had lived through the Depression and the terrible times that went on in the stock market back around that time frame. So he was not a big fan of equity investing. And this was the approach that Ken used to get his dad engaged. Now, I was showing this to a friend recently, family member also, looking over my shoulder, and they said, you realize that's actually modeling a pension. And Ken, I think you'll get a kick out of this. And the difference is this is a personal pension. It behaves just like a pension, only you get to keep the underlying assets, those 5 utilities up at the top. With a pension, you pay into it and you buy things like those top 5 things, but you or your successors don't get to keep those. So it'd be an interesting topic maybe to expand on a little bit sometime in the future, Ken, as far as that type of pension characteristic versus a 401k.
Mark, we're getting a question or two. Can you explain just one of the top 5 lines? Current value makes sense. That's just number of shares times current price. But where does the cash flow number come from, Mark?
Yeah, that cash flow is the amount that was originally invested. Those 120 shares at that 74.44 price. 120 shares at that. That was the original cash flow into the portfolio, so it's negative. So you're basically measuring how much did you put in, and you see the negative $9,000 for those 5 stocks. Again, this is just mathematical convention. If it gives you a headache, I apologize. But anytime that money is taken out of the portfolio, the $110 checks, you'll see it's opposite to what was put in. So these are positive numbers. And hopefully that clears it up a little bit. So you can see the amount actually originally invested. That would be these cash flows up here at the top versus what they're currently worth. And obviously,
Okay, so
South Jersey's done a that's
so
principally
the
gas utility
appreciation in stock price is included in this set of numbers then, right?
in the current value. Absolutely,
Absolutely. Okay.
yeah. So they're worth now roughly $53,000 roughly. So the original 45,000. Again, the intent is to buy a fairly stable investment that won't go up too much or down too much, but will generate a sufficient dividend stream, and they certainly have. So I think we'll probably come back to this in a couple of months and spend some more time on it, but just wanted to kind of warm up to the thought, and those are kind of fun numbers. And just this overall concept of, this asset paying, directly paying the utility bill month in and month out. All right. So with that, just a reminder that we do have a roundtable tonight down there at the bottom. We are going to have a special edition working with the folks from St. Louis on April 26th. Candace Baker will be joining us on that evening. We're going to have a two-part session where we have an educational topic. That topic will most likely revolve around the theme of workhorses in your portfolio. I don't know what to call it yet, Ken, but that's basically what I had in mind of those, the biomets and the less flashy companies in portfolios that just, the Danahers and the Gentexes and that type of stuff. I think that's what we want to talk about, finding them and enjoying them. So what are your thoughts on that?
Well, I like the topic an awful lot. I'm trying to come up with a title here. While I'm trying to do that, Mary Hendrickson has her hand in the air. So Mary, I'm going to unmute you and give you a chance to speak. You're muted on your side, Mary. So if you want to talk, you'll have to unmute yourself.
Okay, thank you. I'm sorry, this is my first time. I just joined your group and I'm so excited to be part of it. My husband's watching this with me also, and if on the previous screen we were our brains were stuck on why the relative return, let's say for Next Era Energy, is negative 0.3%. Why is the return negative when the stock is obviously worth more than when it was purchased?
Yeah, that's simply a comparison. We usually compare to the Wilshire 5000 for a traditional investment. In this case, we're actually comparing to a utility index. So what that's telling you that the average utility stock last year actually over this period of time has gone up 13.7, and that's why this number is slightly negative. Now that's not a bad number. This is not a bad number. Those are all actually quite good. But look at this one down here at the bottom. It's not bad, but it's certainly more average, if you will. And notice that it's trailing the utility average by a few percentage points. Wouldn't panic at all over that. But from top to bottom, you can see, well, which one is thrashing the average utility stock, and that's South Jersey. And then those other two are pretty much right in with it.
I would start out that answer also by saying, Mary, that the total appreciation for all five of these stocks is positive, and that's the column marked total appreciation. The relative return is just how much is it beating the market by, and two of these are beating the market and three of them aren't.
Okay, perfect. Thank you.
Okay. So with that, I just wanted to give everybody an alert. I haven't got my book. I probably will later today when we get through the roundtable tonight. But everything that I see about this book from the background searching that I've done, Kim Butcher is actually going through this with her book club. Several community members whose names you'd recognize are in that club. And it looks to be pretty good. So we will be obtaining that and probably going over it within the next month or so. So that's just your heads up if you want to play along. Looks like there's some pretty good content in there, Ken.
Absolutely. Mark, we're getting some good feedback from some of our audience. Matt down in Houston says that he really likes the idea of workhorses, and he'd love to see a big, solid team of Clydesdales as the logo for the session, and maybe just a title, something like "Celebrating the Workhorse" or something like that.
That sounds good.
Might give us an entree into what we want to talk about. Yeah.
As long as we're allowed to include Titan or a Dalmatian, that goes with it.
Well, put a Dalmatian with it. Sure enough. Okay.
Good stuff.
Other than that, we've covered the questions. Ann Manning, one of our friends from Texas as well, is pointing out that YETI has a competitor in RTIC, and it's Texas-based. RTIC is. I'm afraid I'm not familiar with that ticker or the brand that might be associated with it. Are you, Mark?
I'm not, but I'll take a look. That did come up in a conversation, not a recent conversation.
Okay. All right. Thanks for the info, and we appreciate it. And other than that, Mark, I've cleared the question box, and yep. I'm getting all ready to have a great roundtable this evening. We have some interesting stocks, and we should see everybody at 8:30. And we are on daylight time here, folks. So it's 8:30 Eastern Daylight Time. Okay?
All right. We'll see everybody tonight. Thanks, everybody.
Mark, here's a